At EY, one tiny question like, "Is there a better way?" may seem a drop in the ocean, but it causes a ripple effect that can spread out to the entire world. Every question we ask can build confidence in the capital markets, can help our clients grow, innovators accelerate, governments solve more complex challenges, and communities to thrive. All of these better questions on a huge scale create long-term value for our people, clients, and society that leads to sustainable, inclusive growth. Every better working answer ladders up to achieve our purpose of building a better working world. So, the question that you ask is the drop that starts the ripple.
Hello, good evening, and a very warm welcome to today's session. Sorry for being a bit late. Actually, we're in the middle of running the ceremony for the new members today. Harun is quite busy there. So, wrapping it up, I'm handing over this session to Roshni today. Roshni, can you please join in and introduce the trainers today?
Yes, that's fine. Thank you so much. Good evening, everyone. Hope you can all hear me. So welcome again, and I hope all of you are keeping well. Today and the next Tuesday, we're going to cover a new topic on value-added tax in Sri Lanka. So I have with me Shakti Bell. He's a senior director who is ably assisted by Daritri. They will go through with you the fundamentals of value-added tax in Sri Lanka and also cover some special schemes that Sri Lanka has the following Tuesday. So I'm going to hand this over to him. And like always, please do ask questions. We are happy to take, and hopefully we can answer whatever clarifications you have. So over to you, Shakti.
Thank you. Hope you all can see the screen now.
Yes, it's visible.
Yes.
Right. Right. So good evening to everyone. We are about to discuss on the value-added tax and indirect tax in Sri Lanka that is in operation for more than 20 years in Sri Lanka. We are going to discuss the key aspects of this tax in the today's lecture. Discussions will be discussing the key aspects of the basic aspects and some of the special features in the next session. So let me take you all through the agenda today. Overview of the value-added tax in Sri Lanka, the background to the tax VAT in Sri Lanka, and the fundamentals of value-added tax, how it operates on value addition, and trying to understand the concept and also the specific concepts in value-added tax, taxable supply, time of supply, taxable activity. So understanding the concepts in order to understand the requirement of a registration for VAT in Sri Lanka. And once you register, what are the obligations that you have in computing the value-added tax liability and making payments and filing tax returns. So the computation aspect in a very high level to understand how the computation is done, and then moving on to the reliefs. So the key aspects in VAT, the computation is basic, but when you go into detail, the reliefs, discussion on reliefs, including the reliefs that are available to all the businesses, and there are reliefs for specific businesses and new businesses. So all the reliefs, including the exemptions, we'll be discussing in detail. And then a specific reliefs for special projects, identified special projects, how the reliefs are granted, and what the differences between the general businesses and these special projects reliefs. And then moving on to the developments of VAT over the period, because I told you it was there for 20 years in Sri Lanka. So we'll be trying to understand the developments over the period, especially time to time there were structural changes to this VAT concept. So we'll be understanding that changes in the past in order to understand the current VAT. And then finally, there is a special VAT, special value-added tax on financial services. So that is completely outside of the normal concept of VAT. So that is also a part of the VAT, but the special VAT on financial services. In addition, finally, we'll be discussing on the proposed special goods and services tax in Sri Lanka, that is in lieu of VAT, replacing VAT in certain identified items, not for all, but this special GST will be replacing VAT and other industry taxes for identified goods. So that's only at a proposed stage, but we'll be discussing a high level aspect so that you get a complete understanding of the VAT system in Sri Lanka. So we'll be, as I mentioned to you, we'll be discussing basically 1 to 5 and part of the 6 reliefs also in our today's discussion. So the VAT was replaced, GST was in place prior to 2002, and VAT was replaced with the GST was replaced with VAT from 2002 onwards. Now it's 20 years. We continue, and it is based on the Principal Act 2002 and all the amendments over the period, 17 amendments. So there is no consolidation. So it's basically all the amendments are applicable as of today. And the rate of VAT as of today is 8%. That is from 2020 January onwards. And VAT is administered by the Department of Inland Revenue, the same authority that administers the income tax in Sri Lanka, the direct tax. So it's administered by the same authority. And if you see the statistics, the persons registered for VAT in 2020, it was 8,152 persons registered for VAT and contributed 233 billion. But the same VAT contributed in 2019 was 433 billion, with roughly around 29,000 registered persons. So you can see clearly there is a drop in the registered persons and the VAT revenue. So let's see what has happened. So when we discuss, we'll understand the reasons for the drop and the drop in revenue and the registered persons. So let me take you through from the basic fundamentals of VAT. So for an illustration, I'm just taking from the illustration at the beginning. So VAT is applicable at the standard rate of 8% with an input credit. So if a manufacturer, if he has an inputs of 60 and value addition of 40, then selling price is 100. So he will be charging 8% VAT on the selling price. So the total price goes up to 108. So he will be collecting the VAT at 8%, 8 rupee, and he will be paying this 8 to the tax department. If he has any input VAT, he may be able to claim. But since in this illustration there is no input VAT for manufacturer, so the VAT payable is 8 is paid to the department. If the same product is sold to the distributor, he will be buying it at 100 plus VAT, he will 108. So there is a VAT of 8 input VAT for him, and there is a value addition of 10. So the total price, selling price is 110, will be subject to VAT again. So that VAT is 8.8, that is 8% on that. So distributor will be collecting VAT 8.8 and paying to the tax department only 0.8 because he has already paid an input VAT on the purchases from the manufacturer. What would happen if he supplied to a retailer? Then the retailer will buy it at 110 plus 8.8 VAT. Then the value addition he adds values of 11 and selling price is 121. So on 121, 8% he will collect. So that is 9.68 he will collect. So he will settle VAT recovered, that is the output VAT is 9.68. VAT paid on purchases on his inputs, that is the input VAT 8.8. So he will be paying to the tax authorities 0.88. So what you can see here, all three parties charge VAT, and there is an input mechanism so that allows them to claim a credit for the VAT paid on their purchases and pay the net. So the manufacturer paid net 8, that is on his value addition he paid. Distributor paid 0.8, that is on 8% on his value addition he paid. And retailer paid 0.88, that is on 8% of his value addition he paid. So although manufacturer, distributor, retailer paid tax on their value addition, who bears this VAT? Do they bear it? Manufacturer bear any part of the VAT or distributor bears anything? No, because they are passing it on the price, they recover it on price, and it ultimately goes to the final consumer. So the consumer bears the tax on this, the total supply, the 121 into 8%, that is 9.68, is entirely borne by the final consumer. So the VAT attributable to the value addition is collected by these parties, but they are not bearing the VAT on this supply. So the value addition, so the VAT is operating on the value addition. Each party pays tax on the value addition. Ultimately, the final consumer pays the tax on the total consumption. So with that understanding, we are trying to understand in detail now. So each party is, whether manufacturer, distributor, how do they collect? What is the obligation? What is the chargeability? Who is required to charge VAT? Whether all manufacturers, distributors, retailers, or is there any threshold for them? Do they need to register with VAT for them to collect this VAT? Once you register, what are the obligations? When you collect VAT, is there a requirement to issue a tax invoices with VAT showing the VAT separately? And when the VAT has to be paid and the filing obligations. So let's move on to understand how this chargeability, the basic concepts involved in this chargeability to VAT. Now we have understood just there is an output VAT and input VAT, and the value addition VAT is collected by each parties. Now we are going to discuss in detail how each party obligation, each party has an obligation under the VAT Act. Whether first obligation, before that, let's understand the chargeability. Who is chargeable? Whether all manufacturer, distributor, retailer, or service provider, or any specific person. Let's understand that. So the sorry, the VAT Hope you all can see the screen. So VAT is applicable at the time of supply. So the VAT, that what we discussed, the 8%, the manufacturer or distributor or retailer collects, the chargeability is arising at the time of supply. So the first concept in VAT now is to understand what is this time of supply. So VAT is liable, applicable at the time of supply on any taxable supply. So taxable supply, not all the supplies, but only on taxable supply made in the course of a taxable activity carried out by a registered person. So it should be in the course of a taxable activity by a registered person. So that is the first part of the VAT chargeability, that is by registered person. So the VAT is applicable on the registered person and on all your importations. If you are a registered person, on your supply of goods and services, you are liable. So for you to be a registered person, what are the criteria that we have to look at? So if you become a registered person only, you are liable to VAT on your supply of goods and services. If you see all the other persons, any person who imports goods into Sri Lanka is chargeable to VAT. So the chargeability to VAT arises at 2 points. One is at the once you register for VAT, then on your supplies and on your imports by any person. So the register, once you are registered for VAT, then you have an obligation. You have an obligation to charge VAT on your supplies. Not all supplies, charge VAT on your taxable supplies. So you need to understand what is taxable supplies now, because we discussed once you register for VAT, then you have to charge VAT on your taxable supply and issue a tax invoice to not all persons, only to the registered persons. So you will be charging VAT and you will be issuing a tax invoice only to those who are registered for VAT. Others you will not issue a tax invoice. So others you will be issuing a VAT inclusive invoice, that is 108. The manufacturer will sell it at 108. But for VAT registered person, you will be issuing 100 and showing the VAT separately. A tax invoice will be issued. Then the payment of VAT. Once you are registered, you will charge the VAT and you will pay that VAT on a monthly basis within 20 days from the month end. So that is a payment obligation. At that point only, you will be computing the VAT payable. So your liability is on your supplies, taxable supplies, and if you have any input VAT, you will deduct it from your output VAT and pay the VAT on or before 20th of the following month. Once you make the payment, thereafter you are required to maintain the records of your output and input as per the record keeping regulations, and then prepare the VAT filings on a quarterly basis. That is due on a quarterly basis, except for specific registered persons. It is applicable on a quarterly basis. It is due within the last day of the following month. So within a month's time, you have to file a tax return, VAT return. So this obligation is there only for a registered person who supplies goods and services. But if you are a person who imports, is there an obligation? No, there is no obligation to register for VAT to pay the VAT on import. But importation, you have to notify to the Commissioner General that you are registering, you are importing any item, then you have to notify and obtain a registration identification number to clear the goods. So without the identification number, you won't be able to clear the goods from the customs. So every imports you require an identification number from the tax department, notifying to the Commissioner General. But practically then how it is managed, because if you are already a registered person, then you don't need to notify on your imports. You may use the same registration for the purpose of imports as well. So the import point tax is collected at the import point. So there you don't find these concepts of taxable time of supply or taxable supply, taxable activity is not relevant because it is collected on any imports at the point of imports and collected as part of a custom duty by the Director General of Customs. Right, so these are the two incidents for VAT. One is if you are a registered person and on imports, or if you are a registered person on your supply of goods and services. So let's move on to understand who is required to register for VAT. So in order to understand who is required to register, we need to understand this basic concept of time of supply, taxable supply, and taxable activity. Because only if you carry on a taxable activity, you are eligible to register for VAT. So then let's look at these concepts in detail. Taxable activity. Who is the taxable activity is basically if you carry on a business. If you carry on a trade or business, then you are carrying on a taxable activity. So if other than the employment, other than in the course of employment, if any activity is carried on as a business or trade is a taxable activity. So there are other incidents for taxable activity, including provision of facilities to its members, clubs and association is also considered to be a taxable activity. Anything done in connection with cessation or commencement of the business. So if you liquidate or bind up your business, then you sell your assets, although there is no going concern of your business, yes, that is also considered to be a taxable activity. So taxable activity not only to the business, but even cessation or even commencement or cessation or any is also considered to be a taxable activity. And hiring, leasing, renting of immovable property, exploitation of intangible property registered in Sri Lanka is also considered to be a taxable activity, right? So now if you carry on a business in Sri Lanka, yes, you have the first eligibility to be a registered person because you are carrying on a taxable activity. Merely because you carry on a taxable activity, you can't register. Then you must be making a supply. Only the supplies are taxable, liable for VAT. So what is the supply? Supply of goods or services. If you supply the goods, the passing of ownership of goods to another is a supply. So when you sell your goods or transfer the goods, or if you sell a goods in satisfaction of a settlement of a debt or barter transaction, so that is considered to be a supply. Supply of services. Any supply which is not a supply of goods is supply of service. So it's very wide enough to capture anything other than the goods. Supply of goods are covered under supply of services. So therefore there is no gap. Everything, any supply will be captured for VAT because any supply of goods falls under the supply of goods. Anything other than that will fall under the supply of services, right? So you are carrying on a taxable activity business. Now you are making a sale or transfer, then you are making a supply. Then what the next requirement to examine whether you need to register for VAT? That is taxable supply. Taxable supply means whether your supply, that sale of goods or service, is made in Sri Lanka. Whether you have supplied in Sri Lanka or service is made in Sri Lanka or deemed to be made in Sri Lanka, then it is a taxable supply. But that all the supplies that are made in Sri Lanka are taxable unless it is exempted, specifically exempted. If it is specifically exempted, that is not a taxable supply. Or other than the exempt supply, all the other supplies are taxable supplies. It may be taxable at the standard rate, that is the rate that we discussed, 8%, or 0%. So there is a 0% VAT. We'll discuss the implication later. So the VAT, now taxable supply means any supplies other than the exempt supplies are taxable supplies. It may be taxable at standard rate 8% or 0%. So how do we decide whether a supply is made in Sri Lanka or not? So the guidance is provided in the law. Any goods deemed to be supplied in Sri Lanka, if the supplier carries out a taxable activity in Sri Lanka and the goods are in Sri Lanka. So these two conditions are met, then that is a taxable supply in Sri Lanka. The person should carry on a business in Sri Lanka. Even a residency is not relevant. You may be a resident or non-resident, but whether you carry on a taxable activity in Sri Lanka is what relevant. First, you have to examine whether you are carrying on a taxable activity, whether you carry on a business in Sri Lanka. Then the supply, if you supply the goods, which the goods also should be in Sri Lanka at the time of supply, then it is a taxable supply in Sri Lanka, unless it is exempted. Right. Then services shall be deemed to be supplied in Sri Lanka if the supplier carries out a taxable activity in Sri Lanka and services are performed in Sri Lanka. Right. So now we know business, you sell a goods, yes, supply, it is taxable supply unless it is exempt. Right. The time of supply, at which point you have to pay VAT on this. When you sell a goods in the business that you carry on Sri Lanka, unless it is exempt, then you know that it is clearly 8% or 0% VAT, unless it is exempt. Right. Then at which point you have to pay VAT. The time of supply is the earliest of the invoice date, payment date, or the payment due date, or the payment date. So, or the delivery of service or goods. If you issue the invoice before the payment, before the delivery of service, then invoice date is the time of supply. If you receive the payment, advance payment, before the issue of invoices or delivery of goods, then advance payment at that point for that particular advance, then you create a time of supply and you are liable for VAT on that receipt. So even before the payment, if you have delivered, before invoices, if you have delivered the goods without an invoice or payment, then also you are liable to VAT because the time of supply is the earliest of the following. But there is an exception. If you issue the invoice within 10 days from the delivery, then you are given a 10 days grace period. If you issue the invoice within the 10 days, then the invoice date shall be the time of supply, irrespective of when the delivery happened, when the payment received, when the payment is due. If you issue invoices within 10 days. Right. There are other certain specific time of supplies rules relating to periodic services. If the invoice, if the supply is based on an agreement involving periodic payments, then irrespective of these, the previous time of supply rules, simply when the payment is received or when the payment is due. So that is a special provision that allows, if there is an agreement for a periodical payments, payment date or the due date shall be the time of supply. Right. So now we have understood the taxable activity, that is a business, supply, that is a sale, taxable supply made in Sri Lanka, the supply of goods is not an exempt good, then the time of supply. At the time of supply, you are liable at 8% or 0%. So let's look at what is the obligation now with this concept, understanding of this concept, at which point you have to register for VAT. Right. So because we discussed at the beginning, the registered person is required to charge the VAT. Only once, although you are carrying on a business, you may be carrying on a business, you may be supplying the goods in Sri Lanka, which is not an exempt goods, maybe a taxable supply, time of supply, but you may not be required to register. Why? Because let's look at the obligation to register. Who is required to register? Who is required to register? So the VAT is charged on the value of supply of goods and services at the standard rate. So when you make a taxable supply, the VAT 8% is chargeable on value of supply. So now we are now understanding an additional terminology, the value of supply. So you are liable to VAT on the value of supply of goods and services. So the goods and services, when you supply, on your supply of goods and services, value of goods and services, you are required to charge VAT at 8% or 0%, unless it is specifically identified for 0%, then you charge at 8%. On imports, yes, you charge VAT at 8%. But the difference is there the same base you are going to consider? No. Therefore, let's understand the base. If you supply the goods and services, you are liable to VAT at 8% on the value of supply, but that cannot be less than the open market value. So that should be an open market value. So it's basically a market value. The 8% on market value. Value of supply of land and improvements specifically excludes, when you compute the value of supply of a land and improvements, the value of lands and improvements before 98 are specifically excluded. So the land is excluded in computing the value of supply. So therefore there is no VAT on the value of land supplies, only on buildings after 98, constructed after, or any addition. So the value of healthcare, supply of healthcare services also excluded. Therefore there is no VAT on that. Subsequently, anyway, it is included in exemption also. Specific valuations are specified for, when you provide an employees benefits to employees, because then you are making a supplies to them. You provide free meals to them or transport services to them. So how to value, if you provide any benefits to employees, how to value, and in terms of lease, hire purchase, what should be the valuation specified in the VAT law, right? So the basic rule is it should be on market value 8%. But what happens if it at import point, VAT is at market value, or what value you consider at import point? Yes, import point, the value base is specified. That is the aggregate of the value base for custom duty, say CIF value, plus there is a markup of 10%, and plus all the taxes that you pay at import point, the excise duty, cess, PAL. So what happens there, effectively, if you work out an effective rate of VAT at import points, it will be more than 8%. Although the nominal rate is 8%, the value base for import is wider than the local sales. So import point 8% is on the value including markup and all the import point taxes. Right, so we understood the value of supply also in this up to now. So taxable activity, you carry on a business. Taxable supply, that is other than exempt supply, made in Sri Lanka. At the time of supply, you charge VAT 8% on the value of supply. Right, now we know the value of supply. So why it is important is value of taxable supply is the key that will determine your requirement to register for VAT. How much the value of taxable supply, although you carry on a taxable activity, taxable supply, liable at 8%, but total value of taxable supply is the key to decide your requirement to register. Let's look at. Then you become a registered person. Once you become a registered person, only you get the eligibility to charge the VAT. Okay. Then we move on to understand who is required to register for VAT. So who have commenced to make taxable supplies in the course of a taxable activity is required to register, but there is a mandatory requirement to register for VAT. Optionally, there is an optional, but first let's see who is required compulsorily or mandatorily to register for VAT. Who makes taxable supplies in the course of a taxable activity, taxable supplies, and the value of taxable supplies that we discussed now, the value of taxable supplies, the value base for VAT on taxable supplies, that is other than exempt supplies. So if you supply the items that are not exempted for VAT, then value of supplies exceeded already 75 million, then you have an obligation, 75 million for a month or 3-month period, or 300 million for a year. If you exceeded already 75 million for a month or 75 million for a 3 months period, then you have to register mandatorily for VAT at the point that it is exceeded. After that, you have to register 75 million or 300 million. So this registration threshold is applicable from January 2020. Prior to 2020, the registration threshold was maintained at a very low level, that is at 3 million per month, for a month or a quarter, 12 million for a year. So that means you can understand from 3 million to 75 million threshold increase. That is the reason why I told you at the beginning, the registered persons in 2019 was roughly around 29,000, but that came down to 8,000 because of this. The registration threshold increased to 300 million for a year. So the question is whether you need to wait till you exceed the registration threshold to register for VAT, or is there an obligation that if you are expecting to exceed in the future, whether you have a mandatory obligation? Yes, even if you have reasonable grounds to believe that your supplies are expected to exceed 75 million in a month or 3 months, or 300 million in a 12 month, then you have an obligation, a mandatory obligation to register. Right. So that is basically the mandatory obligation to register. Now let's see what would be the obligation if you don't exceed the threshold. Is there any obligation if you don't exceed the threshold, or if you don't expect to exceed, likely to exceed the registration threshold? Is there any registration required, or is it available for you to register? So at this time, if you are not required to register, so if you are supplying you may be carrying on a taxable activity in Sri Lanka, the business, you may be making a taxable supply. The value of taxable supplies may be less than 300 million. Then you are not registered, therefore you are not recovering the VAT on your supplies. Okay, but you have an option. That is not mandatory, it's voluntary. If you do not exceed, although you make taxable supplies and does not exceed the threshold for registration, mandatory registration, you have an option to register under voluntary registration. So the voluntary registrations operates to persons who does not meet the compulsory registration threshold can request for a registration on an application. So even if but you should have commenced to make a taxable supplies. Your supplies should be taxable supplies. Then you can request for a voluntary registration. So once you are registered for voluntary, then you are treated as a registered person, and then you have to recover the VAT on your supplies. Thereafter, you are equally treated as a registered person. But only difference, this registration threshold is only a registration threshold. It's not a liability threshold. Meaning, once you are registered, you have to charge VAT on any supplies, even 1 rupee. You have to charge VAT because it's not a threshold, is only for registration purpose. Thereafter, you have to charge VAT on all your supplies. So moving on to the voluntary registration, although I said it's equally treated as a registered person, but you will not get some entitlements that a mandatory registered person has. That is, particularly, you may not be able to enjoy certain reliefs provided under a deferment. For now, I will call it as a deferment scheme. There is a deferment scheme under a simplified value-added tax SVAT scheme. So later on, we'll be trying to understand how it operates. But for now, it is a scheme applicable to defer your VAT on your local inputs. So that means you don't need to pay VAT on your local purchases. You can defer the VAT on your local purchases under this scheme. So that deferment scheme, you can't register unless you are a 100% exporter, or you are particularly identified as a supplier under this scheme. So let's look at those aspects later on. But now, at this point, voluntary registered person, you may not be able to enjoy this SVAT scheme unless you are a 100% export. Got a question? Right. So let me take some of your questions that we have received up to now.
Shakti, are you taking questions now? Hello.
Yes, Roshi, the questions that are relevant to the point that we discuss, if we have anything, we can.
I think, yes, I think there is one.
Yes, is valuable supply included exempt supplies also? Yeah, valuable, taxable supply will not include exempt supply, because there is a question clarifying, requesting whether the value of supply includes exempt supply. The value of taxable supply will not include exempt supply. So it will include only the value of taxable supplies at 8% or value of taxable supplies at 0%. 0% is included, but exempt supplies are not included. Then the question is on why the requirement of for a business to register on a voluntary basis. Yes, there are many reasons why they need to register. Simply, in our example, previous example, the manufacturer, distributor, retailer, if assume the manufacturer register for VAT and distributor is not registered for VAT, and then again retail supplier may be registered for VAT. So if that case, or even distributor is not registered for VAT, then what happens is VAT is not passed through to the consumer. So it will be, if you are not registered, then you are breaking the chain, then you become the consumer, then you are bearing the VAT. So for that reason, you may wanted to pass it through. If you are an intermediary who is supplying goods and services, then you may want to be registered for VAT so that you can pass it on by claiming your input and collecting the VAT on your sales. So it depends on the requirement may arise, but yes, there are reasons to voluntarily register. The second reason is very clear reason, I can say. Yes, for a person who is exporting, yes, he need to be registered, because we will discuss later on, he will be enjoying certain reliefs on his inputs. So for that reason, he may have to register on a voluntary basis. So it's up to the businesses to decide, but there are reasons to register for voluntary basis. Then
Shakti, there's someone asking on, someone is asking on VAT or import point, no?
Yes. VAT on imports, what I explained was, yes, it is liable on all your imports other than the exempt. Specifically, exempt goods are identified. So if the good is exempt, then you don't need to charge VAT on imports. All the other will be chargeable to VAT, but at what value? The 8% on value base is different. I told you that it's on the value liable for custom duty, that is a CIF value plus 10% markup will be added to that, and all the import point taxes will be added to the value base. If the 100 is a CIF value, 10% markup 110, PAL is 10, then there will be a 10, 120. If there's a cess of 15, then it's 135. So if there is excise duty, it will be added on. On that value, you pay VAT 8%. So that's why I told you the effective rate is higher than 8%. Can this digital subscription be changed with VAT or charged with, charged with VAT? There is no reverse charge. There is a question on reverse charge mechanism. There is no reverse charge mechanism in Sri Lanka. So you are right. The question, yes, if you are not registered for VAT, yes, their burden will be input VAT will be a burden to you. So if you are not able to register, your input will be a burden to you. And some of the other relevant questions.
Shakti, there's a continuation of that question. No? What about an unregistered person? How the burden of tax will be shifted to the end consumer?
Yes, unregistered person, how the burden of tax will be shifted to the end customer. So that is why I told you, if you are not registered in between, then you become the final consumer. So then you bear the burden. So there is no mechanism to pass it on. So only the voluntary registration, but that is only applicable for taxable supplies. So the voluntary registration permits and allows you to pass it on. Otherwise, yes, it will be a burden. You may not be able to shift it.
But you might be able to include it in the price, which is not really seen.
Yes, yeah, but it become a cost and then it's a price. Yes,
yeah.
It will be part of your price. Yes.
Yeah.
Is it only import goods, or do we have to charge VAT on import of services? No, it's only on importation, because only importation of goods are liable. The supply of services is in Sri Lanka. If it is rendered in Sri Lanka, is only liable. By a business register, you must carry on a taxable activity in Sri Lanka. If you have a business in Sri Lanka, then if you are supplying a service in Sri Lanka, maybe to a person outside Sri Lanka, but your business is in Sri Lanka and you are supplying a service based in Sri Lanka. But there are reliefs. If you receive in foreign currency, there are reliefs. So let's discuss that. Under the zero rated, there are reliefs.
I think we have looked at all the questions, no?
Yes,
are there any more? I think
no. Yeah. So we have looked at the questions. Maybe
are you double checking to see we've answered everything?
No, yeah, that's fine. Right, I'll moving to the next point. There is one more point to highlight here on the registration. Sometimes you may have an obligation to register. I told you even taxable activity includes commencement or cessation of a business. So if you are your business may not be registered for VAT because your threshold is below and you have not registered on a voluntary basis. But when you dispose your assets, say on cessation of your business, you are trying to sell, transfer, sell you all your assets at that point, the total value of supplies may exceed 75 million at that point. If that is the case, then whether you need to register, yes, technically you need to register for VAT, even if it is a single transaction, because it is part of a taxable activity. Therefore, if the goods are liable for VAT, then you have an obligation to register even for a single transaction. A single isolated transaction exceeds 75 million, you have an obligation to register, but the law provides a relief. If it is a single isolated transaction, because of that you have to register for VAT, the Commissioner General may exclude it from the registration threshold and relieve you from the requirement to register. So that will have to be based on an application request, and Commissioner General will have to exclude it specifically from the registration requirement. Otherwise, of course, you have an obligation to register. Right. So now let's move on to the computation aspects. Because now we know taxable activity, business, taxable supply other than exempt supplies, time of supply we know, and the value of taxable supplies we know. Then how do we compute this? Because once you are registered, you have an obligation to compute the VAT. So once you are registered, you may be making a taxable supply as a manufacturer or wholesale retailer or service provider. Later on, we'll discuss, actually, there were changes over the period in relation to trading, the VAT on trade. But currently, manufacturers are liable, wholesale retail, all trading and services are liable. So once you are a registered person, in this example, I'm taking a revenue of 1,250. This 1,250 into 8%, that is the output VAT 100. If you have a output VAT of 100, and if you have an imports input VAT that is 60, that is VAT only I have considered here. VAT on the import, you have paid 60. Input VAT on local purchases, you have paid 20. So the total input VAT you paid is 80. So the VAT computation is simple. What you do is your output VAT is 100. How much you have collected on your taxable supplies is 100. You deduct whatever that you paid on your imports and local purchases. The total is 80. If you are not permitted to deduct, that is considered to be a disallowed input VAT. Then you need to understand why it is not allowed. We'll discuss. There are certain specific inputs which are not specifically allowed. Then you deduct. And allowable input is, in this example, is 60. So the 100 minus 60 is 40 is the VAT payable. As you all know, this is payable on a monthly basis. So you will perform this calculation on a monthly basis to arrive at the monthly VAT payable, and which is due within 20 days from the month end. So if you pay this on a monthly basis, this is the calculation you do. Let's try to understand. On the basis you are a registered person and the supplies are taxable supply, not exempt, right? So what are the things that you need to understand? What is the basis of accounting? Is it on the revenue you pay output VAT? We discuss it's at the time chargeable at the time of supply. So it's basically time of supply basis you have to determine, and you have to account for this VAT on a accrual basis. So the registered person shall account for tax on an invoice basis, that is accrual basis, unless approval is obtained for other bases, especially the cash basis. If you obtain a specific approval, then when you invoice for this 1,250 time of supply, you charge the VAT, but you don't pay the VAT. You can wait till the customer pays you the VAT. That is only when you have obtained the cash basis approval. You can wait till the customer pays you this total with VAT. Right. So that is the basis for VAT liability. Now let's look at what are the other aspects that you need to focus on this VAT computation. The first one is taxable. I told you, I have assumed here everything is taxable. So taxable supplies do not include any supply specifically excluded. You remember that I told you value of supply excludes the land value, and medical healthcare services specifically excluded. So therefore those will not be included in taxable supply. And any supply that are specifically exempted for VAT should not be considered as a taxable supplies, and 8% VAT is not applicable. So that is the first point that you have to look at when you are computing a VAT computation, whether your supplies is a taxable supply. So first you have to exclude the specific exclusion and remove the exempt supplies. Identify whether the item is exempt or not. If it is not an exempt, then it is taxable, either at 8% or 0%. Then you have to find out what are the items that are liable for 0%. All the others are liable at 8%. So there is no list of items that are liable for 8%. 8% is a default rate for all the items, but exempt item you have a list of items. 0 rated, you have a list of items. Then you go to the input claim. What are the aspects that you need to look at when you claim this 80, total input 80, and we have disallowed 20 and claimed 60. So this process of disallowing 20 and claiming 60, what is the basis? Is there a documentation support is required? Is there a time limits that for you to claim this? Because there was a question on that. Yes, I'm trying to answer that at this stage. Is there any time limit to claim this? Yes. What happens is, if you input claim should be supported with a valid tax invoice. So whatever that total input of 80, that is imports 60 and local purchase 20 should be supported with the 20 should be supported with valid tax invoices. So there are specific rules on which, the timing at when they have to issue the tax invoices within the prescribed time limits. So it should be issued within the prescribed time limits. Technically, the time limit for tax invoice is counted from the time of supply. So that we discussed earlier, time of supply within 28 days, a tax invoice should be issued. So you receive a tax invoice within the time of supply, the specified time limit, then it's a valid tax invoice. Plus, specifications are specified. What it should contain. Specifically, the word tax invoice word should be there in the invoice. So all the specifications should be there as specified in the law. Then only it is a valid tax invoice. You may have paid input VAT 20 on purchases, but those are not valid tax invoices. Maybe a tax invoice, but not an acceptable because it does not contain all the elements that is required to be included. Then it may not be allowed for a deduction. Right. So the first key thing is it should be supported with a valid tax invoice. If it is import, it should be supported with valid custom declarations. And then, is it sufficient if you have these documents in place and claim? No, it should have been claimed in a return. That return should be filed within the 24 months from, if it is an import documentation, if it is an imports, January imports, you can claim in a return that is filed within 24 months from the January. So that January 2020, then you can claim within the December 21. You have time till during the 2020 or December 21 up to December 21 you can claim, but you should file a return. If it is a local purchase January invoice, you should have claimed within the 12 months period, that is before the 31st December period. If it is a January invoice, it should be claimed within January 2020, then it should be claimed within the Jan to December period, 12-month period. But there are timelines. Specifically, the counting starts from the taxable period, within a taxable period. So there is the timeline. So input should be claimed within the specified timeline. Right. Supported with valid tax invoices and custom, claim within the timeline. Then next, what other aspects that you need to look at? Disallowed input VAT. I told you that 20 is disallowed. How do we arrive at disallowed? What is the criteria or the requirement? Any input not attributable to taxable supplies are disallowed. You may not only carry out a taxable supply, you may be carrying out a supply. Your items may include, your sales may include, some of the items may be taxable, some of the items may be exempt. Then the input should be directly, you have to identify what is attributable to taxable supply only allowed. If you have input incurred for exempt supplies, that is not an allowable input. And there are specific inputs disallowable rules that includes motor vehicles used for traveling, any motor vehicles used for traveling, car, lorries and things you can, because transport, motor car, motor vehicles used for traveling, any inputs on input VAT relating to motor car, maybe repair or insurance or services, all the input relating to motor vehicles are not allowed specifically. And invoices issued prior to commencement of the VAT liability, because we discussed the registrations requirement. Of course, you have to commence your taxable supply, but there are instances where before commencement of taxable supply also you may be registered, that we'll discuss later on. But in case if you have registered and if you have invoices received that are relevant to periods prior to commencement of VAT liability, those are not allowed for a deduction. Right. So once you identified what are the specific disallowable input VAT, you remove it or deduct it from the total allowable input VAT. So then finally allowable input VAT is 60, that is after disallowable input VAT. Do we have any further restriction? If in case if my input is more than 100, the output is 100. Say for example, in this example, if I have local purchase also 60, then altogether 120, input is 120. Can I claim this 120 against this 100 output? If I have supportings and all are relating to taxable supplies? Yes, I can, but I cannot deduct that entire thing in this month. I cannot deduct entire things in this month. Then what can I be? I'm eligible to deduct, but I'm not permitted to deduct entire 120. Why? Because there is a specific restriction. There is a specific restriction. Before I come to that restrictions, let me explain you any adjustment that are permitted, because we discussed the VAT is on accrual basis, right? Therefore, there may be instances where certain customers may not pay the bad debt, or if it is a bad debt because you paid VAT on accrual basis. So therefore you are permitted to adjust for any bad debt, and there is no time limit. You can adjust provided that you prove it is really a bad debt, so that you are allowed to adjust for bad debts. Is there any other adjustment? Yes. If the original value of supply is changed subsequently due to any reasons, incorrect VAT rate or any subsequently change, so you revise your original supply invoice through a tax credit note or debit note, you are permitted to adjust only through a tax credit note or debit note. If the original invoice supply is made on a taxable supply and tax invoice, then it can be adjusted through tax credit or debit notes, but specific circumstances in which this can be issued is specified, and timelines also specified, not like bad debts, but here this adjustment can be done only within 6 months from the original invoice date, tax invoice date. So it can be done, adjustment can be done, but within 6 months. So let's move on to the restriction. I told you if you have 120 input, you can't claim, you can claim, but not in this period. So what is the meaning of it? Yes, you are allowed only a maximum of 100% of output only you can claim input. That means if you have excess input, you may not end up with a refund, because the calculation permits only 100% of the output. So if you have 100, only 100 input you claim. The balance you carry forward. You carry forward to the next period. You are allowed to claim, but not in this period. How long you can carry forward? Any time. There is no time limit. So any period you carry forward. So when you carry forward this input, same input, next period also, it will be subject to the same restriction of 100%. So it will be a brought forward input, current period, total, subject to this limitation. But this limitation, since this limitation is there, you cannot end up with refund. VAT refunds will not arise because it's always carry forward of input. But this restriction is not applicable to 3 identified categories of persons. So therefore, for them, they will end up with VAT refunds. Only those 3 categories can have a VAT refund situation, because others, the input is not allowed to be claimed more than output. So who are those 3 categories? One is 0 rated supplies. So if your entire supplies is 0, then output VAT is 0. Then your input is always, you will not have an output. Therefore, you are allowed to claim. If your supply is 0, you don't collect VAT. Therefore, entire input becomes refunds. Suspended supplies by an RIS. So we'll discuss later on under SVAT scheme. Under SVAT scheme, deferment for local purchases. We'll discuss that, and I will explain that part. And the persons registered under section 22(7) is also a relief for new businesses, because new businesses, you won't be able to register unless you commence to make a taxable supply. But there is a relief, and you may be able to register under section 22(7). So those 3 categories only can end up with a VAT refund. All the others will have merely a VAT carried forward. What will happen to this carry forward input? Yes, it will be carried forward. I told you there is no time limit. But in the past, when this was introduced in 2007, and then in 2010, sorry, first in 2010, they closed it and said any unabsorbed input carried forward at that particular cutoff point. They said you cannot carry forward, but they gave a credit in other forms, but they did not allow, the law did not allow us to carry forward in the past. So that's just an experience. At some point, they have closed the door, all the carried forward, gave you some form of other credit, but not allowed to set off with the VAT. So from 2012 onwards, so that now 10 years, no restriction, you are carrying forward. Right. So what are the other aspects that you need to understand in tax computation, VAT computation? So this is on the basis that the item is liable, chargeable to VAT, time, so taxable, input claim, disallowable, adjustments we discussed, the 100% and the refund. So the excess input, those I told you that 3 categories: 0 rated supplies, suspended supplies, registered person under 22(7) will be able to claim excess input, and they are eligible to claim the refunds within 45 days. Now it's actually technically 45 days, but practically it's more than years. So practically it takes years to claim the refunds, but you know, the process, practical approach, the process, it will have to be audited by a tax department. So they will carry out a detailed tax or VAT audit. Upon verification of invoices, VAT refund will be confirmed. So it takes time, but technically you are eligible to claim within 45 days to receive the refund within. Let's move on to the reliefs. Let's see whether you have any questions at this stage.
Shakti, there is a question. What is the difference between zero rated and exempt supplies?
Yes, that's a major difference. There is a major difference, because if your supply is exempt, because you can see that what we are going to discuss, the reliefs under the VAT is exemptions. If let's discuss that exemptions, maybe with that discussion, I think we can understand. Roshi will take that question together with this discussion on exemption.
Okay, so there's another question, maybe you can cover that as well. It's a they ask, will exempt supplies qualify for benefits as zero rated does?
Yes, I think that also you are right. I'm going to discuss. So maybe I'll go to that exemption relief, because that's the only relief that I will be discussing today. The rest of the relief, okay. Yeah. So let's move on to the exemptions, and maybe I'll discuss the questions thereafter. Right. The exempt supplies, in this example, in this illustration, I'm trying to say, okay, what we discussed, the taxable supplies. This is the example that we discussed for taxable supply. 100 output, 80 input, disallowed 20, 60 allowable, 40 is payable. So what will happen if the supply is exempt? If your supply is exempt, the item is exempt, then you will not collect the output VAT, but you will have the same input VAT on imports, on local purchases. So the total input VAT 80 become disallowable for this person, because assuming this is one person carrying out both taxable and exempt, then he can't claim this 80. So there is allowable input VAT, there is no allowable input VAT for exempt. So therefore this person who supplies this will be suffering an input VAT as a cost. As we mentioned earlier, this will have to be then embedded in the revenue. Sorry, the sale price will have to be revised to include this cost. So there is no VAT payable on exempt supplies. So if you are exclusively involved in exempt supplies, then you are not eligible to register for VAT. But if you are registered for VAT because of you have a taxable supply, then you are allowed to supply the exempt supply. But then whatever that input relating to exempt supplies will be disallowed in your tax computer. So if assume this person is supplying both taxable 1250 and exempt 1250, his computation will be, he will declare output 100, the input will be 80 from taxable, 80 from exempt. The 80 from exempt will be fully disallowed. So he will end up with payable of 40, right? So exemptions are granted for VAT is identified in the first schedule to the VAT Act. That first schedule identify exemptions for each category, that is for import separately, only items that are exempted for imports, import and supply exemption, the second level, import and sale level, and supply of goods or services separately. So any supply of goods, that means, or services specifically identified. So if your item is not there in that item of imports, then if item is there in the import, then it's only exempted at import point. If the item is there and import and supply, then it will be both import and supply is exempt. If the items included in supply of goods, then it's local supply of that goods is exempt. So inputs attributable to exempt supplies are disallowed. So that's a key difference now when it comes to from exempt to the taxable supplies or zero rated supplies, because zero rated also taxable supplies. So they are eligible to claim this. We discussed earlier, even if you are supply zero rated, you are eligible to claim, but because it's taxable. But exempt supplies, you are not eligible to claim input. So that's a major difference. So let's look at some of the key exemptions. It's a list. It's a lengthy list, but it's items in terms of items, more than 200 items. But just to identify the key exemptions for your understanding, pharmaceutical products are exempt from VAT. Cellular mobile phones are exempt. Solar panel modules are exempt. Educational services, public passenger transport, not private. So if it is a cab services or anything, transport service is liable, but only public passenger transportation. Electricity, healthcare services exempt. Unprocessed agricultural, fishing products, vegetable, fruits, fish exempt. Locally developed software is exempt. IT enabled services specifically identified and prescribed in a gazette, that is from April 2021, and financial services is exempt. So these are some of the key exemptions that we have listed. The implication of exemption, is it a relief? First of all, if we look at as a relief, if your product is exempt, but as you can see here, the 80 becomes a disallowable cost, input cost. But certain industries, when they exempt the output, there is also a corresponding input exemption is also granted, especially in respect of capital goods. Say for example, electricity is exempt, but when you solar panel modules are exempt. So likewise, there are some equipments for CEB when they buy, so there is specific exemption. So electricity equipments there is an exemption at import point, so you don't need to pay VAT on that. So that's thereby you are protected from your input as well. So whenever there is an exemption for output, there may be a corresponding exemption for input as well to protect your input side, at least on the import point on capital goods. When previously there was an exemption for telecommunication service from 2011 to 2016. So during that exemption period, telecommunication service were exempt, and all imports of telecommunication equipments were also exempted, because to manage this input cost, whenever they give you this exemption as a relief, then there will be a limited inputs exemption on import as well is recognized in the past. So IT enabled service, although it is, then you will see the input side of computers are exempt, computer accessories, certain limited accessories are exempt. So there will be a input also on that input side also, no VAT. Right. So finally, if the item is exempt, because there was a question, if the item is exempt and if that qualifies for a zero rate, yes, the zero rate, it can still qualify for a zero rate. Say for example, tea is exempt, but when you export the tea, it become an export and may qualify for zero rate. So what prevails is zero rate will prevail. So we'll discuss those aspects in our the rest of the reliefs discussion in our next session. We'll be discussing the rest of the reliefs, including zero rate and other deferments at import point and deferment at local supplies, and the other developments, plus the special VAT on financial service introduction and the newly proposed GST on specified items replacing VAT. Yes. So let me take any questions at this stage. Let me see your questions.
Shakti, I don't think I can see any questions. I think we've answered everything.
Okay, I think, yeah, cellular phones, yes, exemptions I answered.
Can I ask if there are any more questions before we conclude the session for today? Shakti, check, no? We've answered everything.
No. One of the small question on this, will the exempt supplies will qualify for the benefits zero rated? Yeah, we have answered, but adjustment in relation to making adjustment to the errors in the VAT calculation, the VAT calculation errors is different from the value change in the value of supply or value of tax. Incorrect VAT collected is only can be adjusted through debit note, credit note. But if the errors in the computation, in computing the disallowable or arithmetical errors, so that will become that is an adjustment to the tax return you file. Of course, you can amend it. That's an amending your tax return you file, but it's not from these debit note, credit note adjustment. So it will have to be an amendment to the tax return that you file. So when you amend it, there are consequences, because you will lose your eligibility for time bar period as well, because you have not filed a complete return. Original return is not a full and complete return.
Someone is asking what RIS and RIP stand. So I think we will be, that is registered identified supplier and registered identified purchaser. That's in relation to a special scheme. We'll be touching on it in our next session.
Yes.
I saw one more question.
CGIR stands for the Commissioner General of Inland Revenue. Yes, it's answered. Yeah, the VAT exemption on mobile phone is only for VAT, but other exemptions depending on the HS code, whether there is an exemption available for custom duty or other duties, depending on the specific exemption for that product. But only for VAT, yes, it's exempt. So the exemption mean is only for VAT exemption I listed. So this exemption does not automatically extend to other taxes at import point. Import point exemption meaning it's only for VAT purpose.
Yes, Shakti, I think we've answered, I think, almost all the questions. So if the audience doesn't have any further questions, I just want to thank Shakti and Daritri for today's session. I hope all of you sort of understood the basics of VAT, how it functions in Sri Lanka, and why it is important to register and why it is important for proper compliance, because it might, you might end up with a cost because it's indirect tax, as you know. So until next time, have a good evening. We'll see you next Tuesday. Thank you.